Welcome to the Chapter 8 tutorial. Chapter 8 focuses on two main topics, internal controls and also cash. Let's start off by talking about internal controls. There are basically four goals for internal controls, and these are the ones at the top here. So when we talk about internal controls, one of the goals is to encourage operational efficiencies. So internal controls are things that a company builds into their operations to help achieve these goals. So when we talk about operational efficiency, it's just trying to make sure that things are done in a very efficient manner to speed things up, but still maintaining accuracy. Another goal is to prevent and detect error and fraud. Now, error is something that is unintentional. An employee might make an honest mistake, whereas fraud is something deliberate and intentional. The third goal is to safeguard assets and records. The company wants to make sure that all their assets are protected, all their accounting records are protected, and the final goal is to provide accurate and reliable information. So the company wants to make sure that all the financial reports, all the financial statements that they produce for their investors, for the bank, are accurate and also reliable. Now, the next component is talking about 5 components of internal controls, or 5 parts of internal controls. And the textbook basically uses this acronym CRIME. And so there's 5 parts to internal controls. The first one is control procedures, or the control environment. And they talk about the tone at the top. And what they mean by the tone at the top is that the top employees, that being the senior management and the board of directors, they have to set a positive ethical tone at the top so that their behavior, their positive ethical behaviors, will filter down to all their employees below. So that's the first part of internal control. The next one is risk assessment. And what we mean by risk assessment is we want to identify all the areas where there are risk or weaknesses. And the third is having a good information system. The information system is used to track the assets of the companies, the profit and losses, and usually that relates to perhaps the accounting software that they use. They want to make sure that the accounting software is reliable to accurately track all these amounts. The fourth component is to monitor the controls. And what that means is once the controls are put in place, there should be regular reviews done to ensure that all the controls are operating as intended. And then the final component is environmental controls. And what we mean there is that there should be rules and processes that are implemented to make sure that these goals are achieved. So for example, it might be something as simple as having a daily backup of all the accounting data to make sure that if there ever was, let's say, a fire or a flood, then all that accounting data would be backed up daily, so it would not be lost. The final thing I want to talk about with respect to internal controls is characteristics of an effective internal control system. So let's talk about examples of each of these characteristics. The first characteristic of an effective internal control system is that competent, reliable, and ethical personnel are hired in the company. And so one way of doing that is, for example, before an employee is hired, to do some reference checks, maybe do some testing to make sure that they're able to do the job. And the reference checks will make sure that they have a good ethical record. The second characteristic is called assignment of responsibility. What we mean there is that we want to make sure that each employee is assigned a list of responsibilities. Therefore, if there was ever an error detected, then it could be traced back to a specific employee. The third characteristic is called separation of duties. And what we mean there is that there should be a separation of duties that are incompatible. For example, cash. If we have one employee collecting the cash and also doing the accounting for cash, there could be an opportunity for fraud. And so we want to separate the duties so the employee that has custody or that's collecting the cash is separate from the employee that's actually doing the accounting work for cash. The fourth item is proper authorization, and this one's fairly straightforward. We want to make sure that For example, any large purchases that there's proper authorization made before the purchase can go ahead. The fifth characteristic deals with audits. And when we talk about audits, audits are basically a verification process, and they can be done internally. So for example, there could be an employee who is assigned to do the internal audit to make sure all those purchases above a certain amount are properly authorized. Or it could be an external audit where the company hires, let's say, an accounting firm to come in and verify all their financial statement numbers. The sixth item is using documents and records. And what that relates to is making sure that a company has a proper paper trail. So for example, if the company is reporting $1 million of sales, they want to make sure that they have all the documentation and records to support that $1 million of sales. The next item is using electronic devices and computer controls. And once again, that could be maybe having good accounting software to make sure that at any point in time, all the debits equal the credits, to have those computer controls in place to make sure that they're never out of balance with their accounting records. And then the final one is just talking about other controls. And once again, this could be things simply such as having a fire detector, having an alarm system to once again protect their assets and to protect all their accounting records as well. Now, the textbook also goes into internal controls for e-commerce, and they've summarized those discussions on page 436, 437. So you can just read those couple of pages on your own to look at internal controls for e-commerce. What we're going to focus on is cash, internal control of cash. Now, later on in the chapter, the textbook will go through control procedures for cash receipts and cash payments. But the one thing I want to emphasize is that when we're talking about cash, cash is a very liquid asset. And a $20 bill looks the same. The only way you can differentiate is between the serial number, and that's very hard to keep track of. And so we want to make sure that we have really strong controls when it comes to cash so that it's not going to be stolen by employees. One of the key guidelines is to separate the record keeping from the custody of cash. And that's what we talked about earlier, separation of duties. We want to separate whoever does the accounting or record keeping from the employee that actually has control of the cash, that's able to take the cash and deposit it into the bank account, and that has control of the bank account. So we want to separate those two duties. Another internal control that a company can have with respect to cash is to have a bank account, and most companies do. And what we find more and more is companies using what we call electronic fund transfers, or EFTs. Now, companies still use checks, but more and more when we get into electronic banking these days, more companies use what we call electronic fund transfers. And let me give you an example of that. If a customer owes your company money, rather than send a check through the mail, that customer might just transfer the money they owe you from their bank account directly into your bank account. Also, if your company owes a supplier money, you could transfer the money directly from your bank account to the supplier's bank account in order to pay the amount that you owe. And so those electronic fund transfers are being seen a lot more these days. And one of the reasons why they're beneficial is that it reduces the chance of error and fraud. Because it's done electronically, you can see the money going into your bank account and you can see the money leaving your bank account, and there's no other employees involved. It's just a simple transfer from one bank account to another. Now, there's also another, moving on to page 2 of our handout, internal control that is called a bank reconciliation. And on the top of page 2, a bank reconciliation is done to determine the differences between the bank statement account balance and the general ledger balance of cash. And what we're going to do is we're actually going to go through exercise 8-9 on page 465, 466 of your textbook, and actually go through and do a bank reconciliation. So find your textbook and turn to page 465, 466. And pause the video here, have a read through exercise 8-9, and once you've read through the question, then we'll work through the bank reconciliation together. So pause the video now, and then resume it once you have read that exercise. Let's get started on exercise 8-9. Now, what I have here is basically the heading of the bank reconciliation. We put the name of the company, what we're preparing, a bank reconciliation, and the date that we're doing the bank reconciliation. And when you look at the question, this is going to be done at the end of January, so on January 31st, 2020. Now, the purpose of the bank reconciliation is to make sure that we identify any differences. Usually the bank statement balance will be different from the cash general ledger balance. And the reason for that is due to timing differences. You write a check from your bank account, you send it to your supplier who's based in Toronto. It's going to take some time for it to arrive by mail, and they may not deposit the check right away. So on your cash general ledger account, you would have deducted that amount of the check, but your bank statement has not shown the check being deducted from your bank statement balance yet. So there could be timing differences. And the way we identify those differences is we compare the cash general ledger to the bank statement. And that's what I've done on this over here. I basically just summarized what's in the question. So when you look at the question, E8-9, you see that on page 465, we have the cash account and the general ledger. So this is what is showing in the cash account, debits and credits. And this is for the month of January. And then below that, I have the bank statement, which is on page 466. Now, we know that this bank statement at the end of the month has a balance of $17,960. Now, for the cash general ledger, they actually don't have a balance, but if you add up the debits and you minus the credits, you'll see that the balance at the end of the month is $14,600. So if you add up all the debits minus the credits, the balance in the cash general ledger is $14,600, and that's different from the bank statement of $17,960. So now what we're going to do is identify the items that are different, that are on one but not the other. If they're on both, we don't care about them. If they're being recorded on both, that's good. We can ignore them. We only care about the items that are on one but not the other. So all we have to do then is just identify what those items are. So let's start with the cash general ledger. Let's look at this $40,000 deposit. Does that show up on the bank statement? Yes, it does. And so I can cross it out because it's on both. Let's go to the next amount. Check number 1, 12,000 credit. That's going to reduce our cash. Does that show up on the bank statement? Yes. Check number 1, 12,000 withdrawal. We can cross that out. What about check number 2, 16,000? Yes, that shows up on both. Now you have to be careful because this 16,000 check number 2 is a credit, so that should show up on the withdrawal side, and it does. Now we also have the next item is a $16,000 cash debit, which is a deposit. So then on the deposit side, do we show a $16,000 deposit? We do, so we can cross both of those out. So we just continue on. Does check number 3 show up on the bank statement? It does not. So we circle it because we're going to need this. It's on one but not the other. What about the 12,000 cash sales? It does show up, so we can cross that out. What about this bank loan of 50,000? It shows up on both. We can cross it out. Check number 4 for 74,000 shows up on both. We can cross it out. Check number 5 does not show up on the bank statement, so we circle it. We're going to need that. And then the last item, the cash sales of 25,600 does not show up, so we have to circle that as well. And what this means is if you actually look at the date here, this cash sales happened on the very last day of the month. And so what usually happens is the company records the cash sales on their cash general ledger account. They go to the bank on the night of January 31st. The bank is closed already, so they just put the money in the night deposit slot. And so obviously the bank would not have recorded that until sometime the next day. So that's why it does not show up on the bank statement. So what we've done is we've circled all these items on the cash general ledger account that does not show up on the bank statement. So these three items here are not on the bank statement. Because they're not on the bank statement, they're going to go on the bank side of the bank reconciliation. And we'll go to that in a couple minutes. But let's finish off with the bank statement. And let's look at the items that we have not yet crossed out on the bank statement. We have this deposit of $2,000, this service charge of $48, and this interest deposit of $8. Now, this $2,000 deposit, if we look at the additional information, it's talked about in the question. We noticed that this $2,000 deposit was a bank error, and we told the bank, and they said they'll correct it next month. Now, the thing about bank errors is that errors get corrected on the same side of the bank reconciliation. So the errors are corrected on what we call the same side of the bank reconciliation. So that what that means is if the bank made the error, we're going to have to correct that on the bank side of the bank reconciliation. Whereas these two amounts, the 48 and the 8, these two amounts are not on the books or the general ledger. And so they're going to show up on the book side of the bank reconciliation. Remember, we're trying to identify differences. And so if it's on the bank statement but not on the books, we have to get it on the books. Whereas above here, these items are not on the bank statement, so we have to get them on the bank statement. So now that we've identified these differences, we can now go to our bank reconciliation. Now, this is the bank reconciliation template. In your textbook, on page 442, 443, there are some good examples that you can look at as well. Let's go through this one together, and then you can go to your textbook after this video tutorial and do some extra work on your own. Now we're going to start off with the bank statement balance at the end of the month. And if we go back to the bank statement, what was the balance? $17,960. So that's the starting point. $17,960. And then what's the starting point for the book or the general ledger cash account? That was $14,600. So let's start with that there. 14,600. Now, everything that we put on this side, on the bank side, are things that are on the books, but not on the bank statement. Things that are on the general ledger cash account are books, but not on the bank statement. So these are the items up here. These are the items that are not on the bank statement. So we have to add this deposit, and we have to subtract these two checks. So let's just do that. We have this deposit that has not shown up on the bank statement. That's referred to as a deposit in transit. So we have this deposit in transit that we're going to add because it's not yet on the bank statement, but it'll show up later on. Once again, that's a timing difference. And then we have these two checks. We have outstanding check number 3. That's going to reduce the amount by 10,000. Outstanding check number 5, and that's going to reduce the bank statement balance by 17,000. So those are the three amounts that we circled on the general ledger. Those are on the books, but not yet on the bank statement. Now, we also talked about this error. The bank made this error of $2,000. And so when it comes to errors, we have to correct that on the same side. Whoever made the error has to be corrected on the same side because this error doesn't affect the books, right? It was not made on the books, so we are not going to adjust it on the book side, but the bank is going to correct it next month. So this 17,960, this ending balance, includes 2,000 that is not ours. So how do we take it out? Well, we've got to remove it from the bank statement balance. So if we go back to our bank reconciliation, the bank error is going to be a reduction. It's been included in the 17,960, and now we got to take it out. So we got to remove that 2,000. So if we work through the math, the correct amount of cash that we really have is 14,560. Now the goal of the bank reconciliations is to make sure that the amount that we have on the bank side equals the amount that we're going to have on the book side. So now that we've done the bank side of the bank reconciliation, we can go to the book side. Now the book side are going to be these two amounts here. Things that are on the bank but not yet on the books. So we have to record this $8 of interest revenue. Remember, this is the deposit. And then we've got to record this $48 withdrawal, which is basically is our service charge expense, right? We've been charged this expense by the bank, and so now we have to record it on our books because we don't know what these amounts are, the 48 and the 8, until we get our bank statement. So let's then put those amounts on our bank reconciliation on the book side. So we have interest earned of $8. And now we have this service charge that we're going to have to subtract of 48. So if we work through the math, we start off with 14,600. We add 8 minus 48. We're going to get 14,560. So therefore, our bank reconciliation balances. The correct amount of cash we really have is not 17,960, it's not 14,600. The real amount of cash we have at January 31st is 14,560. Now there's also one additional step. After we do the bank reconciliation, we've got to record journal entries. But the journal entries we record are only on the book side. So we have to record journal entries for these two adjustments. Now remember, the interest earned is going to increase cash. The service charge will decrease cash. So let's go do these two journal entries then. On January 31st, after we do the bank reconciliation, we've got to do journal entries, but only the journal entries on the book side. And so in order to get our cash from 14,600 to 14,560, we're going to do the first journal entry by debiting cash for $8 and then recording the interest revenue of $8. And then we're going to record the expense of $48, and we'll call that bank charges expense. This textbook refers to the service charge as bank charges expense. Remember, expenses are always going to be debited, and we're going to decrease cash, credit for 48. And that's going to bring our cash balance to 14,560. So that's a simple example of how to do a bank reconciliation and also the related journal entries. Let's move on to page 3 of our handout. Now, page 3 first talks about how do we report cash. Well, cash always goes on the balance sheet, and it's always going to be the first asset because it's the most liquid of the current assets. Now, some balance sheets you might see cash plus cash equivalents. And all cash equivalents are just investments that can be easily converted into cash, such as treasury bills or maybe GICs or term deposits. So whenever you see the term cash plus cash equivalents, it just means we take the cash in our bank account plus all the investments that we can easily change into cash that are essentially cash as well. Now, there's also a couple sections in your textbook, page 448, page 450, that you can review on your own. This talks about internal controls related to cash receipts and internal controls related to cash payments. So just look at those two exhibits on your own to get some background information about internal controls specific to cash. What we're going to wrap up with is talking about this concept of petty cash. Now, many companies have what's called a petty cash fund. And what that is basically setting aside some amount of cash, of actual cash, bills and coins, and having that available for small daily expenses. So for example, let's say we have a company and they run out of coffee for their coffee machine. And so they send an employee to the grocery store to buy some coffee. And so rather than to have to write a check, get that approved, they set aside a small amount of cash. It could be $400, it could be $300, and they set that aside. So whenever they need to make daily small expenditures, that employee can just go to the person that is looking after the petty cash custodian, and say, I'm going to go buy some coffee. I need $50. The custodian gives the employees $50 in cash. The employee goes to the grocery store, buys the coffee, brings back the receipt and also the change, and that goes into the petty cash fund. And so in order to do that, we've got to figure out what are their accounting journal entries. Well, the way that the petty cash fund works is that it has to be initially set up with a certain amount of cash. That's going to come out of the bank account. And then as these small daily expenditures are made, nothing's going to be updated until the petty cash balance reaches a point where the company needs to replenish it and bring it back up to that initial amount. And in order to sort of demonstrate how these journal entries are done, we're going to look at exercise 8-21 and 8-22 on page 471. So have a look at page 471 in your textbook. Pause the video here, read through 8-21 and 8-22, and once you read those two, then resume the video to work through these problems together. So pause the video now. Okay, let's have a look at exercise 8-21 first. Now, when we look at exercise 8-21, the company is setting up the petty cash fund for the very first time on September the 7th. So once again, the way that this works is that on September the 7th, they're going to take $500 out of their bank account and put it into a petty cash fund. And so for the accounting journal entries, we're going to set up this new account called petty cash. Now, petty cash is a current asset. And so we're going to take $500 out of our bank account and put $500 of actual cash into like a locked box, a small little safe that the custodian is going to hold and will only give out money for small daily expenditure. So debit petty cash, and we're going to credit cash. So right now we have this new account called petty cash, and I'm just going to set up a T account, and it's just going to stay at 500. So we're never going to touch that again unless we want to change the balance in our petty cash account. And that's what we mean by an impressed petty cash fund. So when you read the first sentence in E8-21, it says, Maritime Distributors created a $500 impressed petty cash fund. All that means is that we're going to leave petty cash at this fixed amount of $500. We're not going to touch it again until we actually want to decrease that amount or increase that amount to an amount other than 500. Now, if you look at the question, during the first few weeks, they spend money out of the petty cash fund for delivery, for postage, for supplies, and also miscellaneous. Now, during those dates, nothing is done to the accounting records. The petty cash custodian will definitely keep track of all the receipts, keep track of all the expenditures, but nothing will be done from an accounting perspective until they want to replenish it. Now, when you look at Part B, it says that on October 15th, they want to replenish the petty cash fund because now there's only $97.58 left in the petty cash. So they want to bring it back up to 500. So 500 minus 97.58. What they need to do is they need to add another $402.42 to the petty cash fund. So that's the amount of cash they need to add to the petty cash fund. But remember, from an accounting perspective, we're going to be leaving the petty cash on the general ledger at $500. But in actual fact, it's gone down to $97.58. now we have to physically add $402.42 into the petty cash fund. Now, when we do that, we're also going to record all those expenses. So this is going to be the journal entry that we have to record on October 15th. Now, we know that we've got to add $402.42 into the petty cash fund. And so in order to have that, we're going to have to get that out of our bank account. So we know that part of this is going to be a credit to cash of $402.42. We're going to have to take that money out of our bank account and actually put it physically into our petty cash fund. Now, what about the debits? Well, that's where we record all the expenses. We're going to record our delivery expense. So if you look at the question, we had delivery expense of $228.80. Then we had postage expense. And once again, that amount was $85.98. And then let's just complete the rest of the expenses. Supplies expense. Now, when you look at supplies expense, there's actually two amounts. There's the $60.40 and the $14.72. So we add those two together. We're going to debit supplies expense for $75.12. And then the last item is miscellaneous expense. And that amount is $9.52. Now, if you just sort of pause there, if you look at your total debits and your total credits, they do not add up. The total debits that we have so far is $399.42. Now, what could have caused this difference? We actually are short. We only have accounted for $399.42 of expenses, but we actually spent $402.42. So we're actually short $3. And this could be just maybe some errors. Maybe when the employee brought back the change, maybe they were given the wrong amount of change and so they were short. It could have been a number of errors. Maybe there was an expenditure made for $3 and they just lost the receipt. And so there's a number of reasons why they could be short. But because we don't know where that amount came from or what expense it goes to, we're going to create this new account called Cash Short Over. Now, this is just going to be an expense account. And we're just going to create this new account rather than put it to miscellaneous expense. The reason that we create this new account called Cash Short Over is that if it's just a small amount at the end of the year in cash short over, then that's fine. But it could be a large amount, and maybe there is fraud happening. Remember, we said fraud is intentional. Maybe an employee is intentionally bringing back less change for their expenditures, and so they're pocketing the difference. And so the company's going to keep track of all these errors, and if it's a small amount, then they probably just write it off to simple human error. But if it's a large amount in cash short over, then maybe there's some fraud happening, and then they'll investigate a little bit further. But cash short over, once again, will usually just be added to miscellaneous expense. You're not going to see a separate expense item called cash short over on your income statement. It will usually just be added to maybe miscellaneous or office expenses when they put that on the income statement. But right now we're just going to leave the $3 difference in this cash short over account. So that would be the journal entry on October 15th to record the expenses and to replenish the petty cash fund. Now let's go on to exercise 8-22. Now 8-22 is just a continuation. So exercise 8-22 is just a continuation. And it says here that the company now decides that $500 is too much. They want to bring it down by 100. And so let's have another look at the T account then. It's currently at 500. We want to reduce it by 100 and bring it down to 400. So now we got to record this journal entry. Now remember, we said earlier that an impressed petty cash fund means we're going to leave it at 500. The only time we change it is if we want to increase the balance above 500 or we want to decrease it below 500. Now we're going to bring it down to 400. So we're physically going to take $100 cash out of the petty cash fund and put that back into our bank account. So the journal entry is going to be a debit to cash. That's going to go into our bank account, and a credit to petty cash. So that would be the only time you actually change the balance, is if you want to actually increase the actual balance or you want to decrease it. And so that is 8-22. A couple of things to wrap up. If we go back to page 3 of our Chapter 8 handout, the textbook also talks about some ethical guidelines on page 453, 454. So just read those as well. That basically just gives you a framework if you're an employee or if your company is dealing with an ethical dilemma. It just gives you some sort of framework to work through that ethical dilemma. Now, there's a really good bank reconciliation in the summary problem, and also exercise 8-26 is good as well. I posted the solution on D2L Brightspace, so go through exercise 8-26 on your own for extra practice on bank reconciliation. And once again, the summary problem in Chapter 8, also really good for your review as well. So that brings us to the end of this Chapter 8 tutorial on internal controls and cash. Good luck with your studies. We'll see you in the next chapter tutorial.